So here in the United States, let's begin with the big issue, shall we? Signs of waning enthusiasm in the equity market.
We're concerned that the cycle is slowing.
We are de-risking in here.
Where's the obvious place to go? Defensive.
Defensive positioning.
Defensive as far as equities are concerned. This means a bit more value play in portfolio.
More people doing value stocks rather than growth.
High dividend yielding stocks.
I would not be at all surprised to see a pullback.
A 5 to 10% pullback over the summer with some uncertainty around the sausage making on trade. The Fed meeting in July, Q2 earnings season.
We are too far extended for the lower growth rates that we're seeing.
We think it's prudent to be a little bit more cautious in your optimism.
So the key question for this table today, is it time to de-risk? Joining me around the table here in New York, John Mackay of Schroders, Jack Manley of JPMorgan Asset Management and Kevin Caron of Washington Crossing Advisors. Kevin, let's begin with you. Is it time to de-risk? Is it time to use the word that was repeated several times there, to get defensive? The equity market's already looking pretty defensive, isn't it, regardless of the fact we're near all-time highs?
Yeah, the answer is short-term no. Washington Crossing has actually been adding equity risk to the portfolio over the last couple months, going from an underweight position where we were last year back to a little bit more than a neutral position, but we haven't retreated from that. We understand the curve is inverted. We understand that it's been a rather long cycle here, but until we see other confirming evidence that things are actually turning over and getting worse, we're staying with the trade.
John?
So I struggle to see what the upside is from here. You're already up 20% or so year to date. Best first half, I think, since 1997. All of that upside has come from multiple expansion. You need growth to push us higher from here. The only thing that I think could come out of left field at this point, given where market pricing is a 50 basis point cut from the Fed. Seems much more likely, given data we've seen recently, it'll be 25, which is right in line with expectations. So, what's the upside,
Jack?
Catalyst?
I mean, I tend to agree with John on this one. I think that we've been up around 18, 20%. Earnings growth is 3 or 4%. How much more can we get? I wouldn't discount the idea of multiple expansion because I think with rates staying lower for longer, there is room for that multiple to push up. But I think there's a whole lot of volatility coming for the next half of this year, and de-risking a little bit is probably the prudent.
Some people might pick up on the fact that beneath the surface, we are already quite defensive, given the fact we've had a decent go in consumer staples, a decent rally in utilities as well. What's the story there?
I mean, I think that defensive play makes sense because I think there's a lot of anxiety out there in markets. I don't know if I would go full defensive. I actually almost like a split allocation between, say, a growth and value approach. I think there is room for capital appreciation because of that multiple expansion, but the income component is more important than ever, especially with rates staying so low.
Kevin, looking at the situation right now, beyond just equities and looking at, say, credit at the moment too, credit is also really tight. It's hard to find a risk asset that hasn't performed really, really well. So if you're going to de-risk from equities, where do you go? Is that the thing that you're looking at? Is that the difficult equation?
And that's the whole problem, because it's easy to say, well, get defensive, but the question is, where do you go? And we talked about German bonds with negative yields and 25% of global sovereigns with negative yields. So where do you go? And the only other places to go would be, let's say, a treasury. Your traditional things would be long treasuries, gold, and cash. Which of those things are especially attractive right now? And if you're going to de-risk, where are you going to go? So our view at Washington Crossing is to be mindful about the types of equities you're buying, maybe by focus on quality and consistency and durability and conservatively financed balance sheets, but be a little bit slow about pulling the recessionary alarm bells yet, because we've not yet seen a real downturn.
So I think it's all about relative plays within the equity market, right? Jack touched on what you can do within the U.S. equity market, but I think you have to look around the world, right? What's got more upside potential if things do get better than expected? What's got less downside potential if things do, if we are moving towards a recession here in the U.S., which inevitably pulls global growth slower? And I would point to Europe. It's not a consensus trade. Sentiment is really, really low. Basically, the bar is on the floor. If you look at economic surprise indices, they're actually heading up, not down, which means a lot of bad news is already priced in. Valuations are low. And if the ECB does do quantitative easing, which you think is a higher likelihood today, you will get multiple expansion over there.